Walgreens stock has fallen lately due to their last earnings report, and in this video I am going to do an in-depth analysis by looking at their income and cash flow statement, their balance sheet, their dividend, and finally using my Excel spreadsheet to see what price you should pay for Walgreens. The stock is down because Walgreens slashed their full year earnings guidance to a range of $4 to $4.05 per share from the previous forecast of $4.45 to $4.65. Another highlight from their earnings is that they announced a cost-cutting initiative of $4.1 billion, and they missed on earnings for the first time since July 2020. However, a positive aspect of the earnings is that they beat on revenue by $1 billion. And this is important because Walgreens, if we take a look at their income statement, we can see here in annual revenue growth that this is not a growing company. It's usually on average between 2 and 5%. However, if we take a look at quarterly revenue, we can see that it has increased 8% from the previous quarter. So this is definitely a positive from their last earnings. If we continue looking at their income statement and take a look at net income, we can see that net income was massively affected during COVID, but it looks like it has rebounded nicely since then, and it is now sitting at $4 billion, which is what they used to do prior to COVID. And we can see this clearly in the chart where they used to average $4 billion prior to COVID. Then COVID hit and it looks like it has now rebounded and is stable. Now let's take a look at their free cash flow statement. If we take a look at their free cash flow, it has massively been affected this last year from $4 billion all the way to $2 billion. This is very concerning, especially for their dividend, because dividends come from free cash flow. And the cash dividend payout ratio on the dividend is currently 76%. And this may be unsustainable as the company's free cash flow has fallen more than 85% over the past 5 years. This could also affect the stock price because if the company does not raise the dividend or cuts it completely the next month, the stock price will likely plummet further. Now the question becomes, what price should you pay for Walgreens in order to make a good return on your money? And in order to answer this question, I am going to use my Excel spreadsheet, which tells me at what price you should buy your stock based on the assumptions that you put in. And I am going to do a 7-year analysis. So let me quickly explain my assumptions before I reveal the prices. We have seen that Walgreens is not a fast-growing company, that they usually grow between 2 and 5%. However, we have seen that in their last earnings, they grew revenue nicely. And if we take a look at what analysts are expecting for this company in terms of revenue growth, they are expecting between 4 and 9% over the next years. I'm going to be very conservative on my low assumptions and I'm going to put 1%. On my middle assumptions, I'm going to put 3%, which is what I believe they are going to do. And on my high assumptions, 5%, which is what analysts are expecting. Now let's move on to profit margin and free cash flow margin. We saw previously that their net income, which is what determines profit margin, was affected during COVID, but it had come back nicely since then. And we can see that they average between 2 and 5% profit margin except during COVID, as I have already said. So I'm going to put on my low assumptions 2%, which again I think is conservative, on my middle assumptions 3%, and on my high assumptions 4%. Then for free cash flow margin, which is where my concern is with this stock, we can see that it is currently 1.6%. which we saw that was affected previously. But the other years they average between 3 and even 6%. So I'm going to put on my low assumptions 2% like profit margin, 3% and 4% on my high assumptions. Then for PE and price to free cash flow, remember that you should not compare the PE with the average of the stock, but rather with the average of the stock market in general. And the average of the stock market is usually around 15. And because Walgreens is a company that has very little growth, I'm going to assign a very low PE on my low assumptions at 11, because if they only grow 1%, I'm going to assign a low PE. Then for my middle assumptions, I'm going to put 13. And on my high assumptions, if they manage to do 5%, I'm going to give them the market average of 15. Then the discount rate is the return you want to get each year on your investment. And you can get around 9% investing in an ETF. So if you take the risk of investing in an individual stock, your rate of return should be higher. And because Walgreens has some issues with their free cash flow margin, I'm going to put 11% on my low assumptions, 13% on my middle assumptions, and 15% on my high assumptions, which is a lot. As you can see, according to my Excel spreadsheet, this stock is a buy according to my low, middle, and high assumptions. And according to my high assumptions, this stock has a lot of growth potential. I personally own this stock, which doesn't mean you should just go out there and buy it. Please do your own research. And my thesis is that I like the valuation, I like their dividend, I think it has growth potential in terms of share appreciation, and that their free cash flow margin is a temporary thing at 1.6%. Because if you believe that their profit margin is going to be 1.5% for the next years, you can see that the stock price drops to 25. So as always, do your own research. I also want to say that this Excel spreadsheet does not take into account the balance sheet and the debt. So let's quickly take a look at the debt of this company. The debt of the company is essentially the difference between the market cap and the enterprise value. As you can see, there is quite a lot of difference of nearly $35 billion. So what I want to say is that this debt doesn't worry me at all, because Walgreens is such an established company and they have a lot of leases as well. So the debt for me is not a problem in this company. In conclusion, I believe Walgreens is a great buy, but as always, do your own research. I like their dividend at 6.7%. I like the valuation as we saw on the Excel spreadsheet, and they have a forward PE of 5.9, which is very cheap. I hope you enjoyed the analysis. Please do your own research, and I'll see you on the next one. Thank you.